how to calculate your internal rate of return on your IUL. So many people think it's just the number that they illustrate. It says 6 point something percent. That's the number I'm going to get. It's not. It's not just your average. It's not just your compound annual growth rate. It's really important you understand how to do this, or at least how to read it. Let's do it. So the first thing I want to show is just on a regular illustration. I'm going to pop this one up here. You can see there under the non-guaranteed category on the far right, the number that they're illustrating at. So in this case, it's 6.42%. A lot of people think, okay, so this illustration means that if I average 6.42% forever, that's what I'm going to get. This isn't the case. See, this may be what you are actually going to get, but it doesn't take into account your fees. So your fees, for example, are your commissions, your annual policy charge, your cost of insurance, your premium charge. There are a number of fees there. Now, over the life of the policy, they can end up averaging less than 1%, and I'll kind of show you how that is the case. Sometimes it's more, but you need to understand how you can find your internal rate of return so you're not promised some big number, and then, a couple of years in, you go and look at your policy and end up being upset with, I thought it was going to be more. Why has my internal rate of return been 0 after 3 years? Let's do that now. Before we get into the IRR, compound annual growth rate is generally taking your beginning number and your ending number and kind of being able to find out if that number compounded all these years, what has been the compound annual growth rate, not just the average. So that can be helpful in scenarios where you're putting in money and you're no longer putting in any more money in the future. You just want to see what it grows to. With IUL, we know that that's not the case. Generally, even if you are doing a lump sum, you're going to spread it out over many years. So there's different years you're putting money in. So what internal rate of return does is it calculates or accounts for your different cash flows in and out. So when you're taking policy loans, it also takes that into account. First, if you're just someone who just wants to know how to look at that number at least, I'll show you. They should be running, or your agent should be running, not only an annual cost summary, so you can see your fees, but an internal rate of return summary. So that should look something like this. You can see your internal rate of return on your accumulation value, your surrender value, your death benefit. You could scroll down and see all of those numbers there. Now in this case, I will touch on here before we move on. You can see if we scroll all the way down to year 30, even though in this example for a 60-year-old that we illustrated at 6.3, people say IULs are so expensive. Over the course of 30 years, we come down, what does we see the net internal rate of return is? 5.3. So just over those 30 years, it ends up holding an IRR of 5.3. Reason being, well, in the early years, fees are just higher. This per 1,000 base, that's over the first 10 years. There's also your premium charge. So he was putting in premiums for the first 6 years. Well, there's charges there. We don't have those anymore. And as the policy goes on, we're getting less and less insurance that we're actually paying for. So even though that cost per 1,000 is going to go up, the actual amount we're paying for is going up. So really the insurance is almost getting cheaper in a sense. Now, getting cheaper in terms of percentage of your cash value that's allocated towards that. You can see the cost of insurance goes up, but as a percentage, it's less and less of your cash value. That's why it's able to average the net percent one fee after 30 years. And if you continue down and live past age 95, which is very realistic nowadays, people are living longer than they ever have, you can see usually you need at least 5% more insurance than you have cash value. Once you hit age 96, for this company, the cost of insurance goes to 0. You don't actually need any more. Your cash value equals your insurance. You're not paying anything for insurance. All right, if you're the engineering type, now let's get into how to calculate internal rate of return. I'm gonna pop up a formula here. Looks pretty complicated, but what you're doing is we're going to solve this formula by guessing what R is, the rate of return. We're not solving this similar to how we would solve an equation in elementary school math class where we isolate the variable and divide by the coefficient and solve for it that way. In this case, we're going to build out the formula and then we're going to guess the number and we're going to continue guessing until we get as close as possible. And then it's safe to say, okay, this is our actual internal rate of return. So I'm going to take you over to a spreadsheet here if you're an engineering type, and let's actually do it. All right, so we can see here in year 30, as we looked at earlier, it is showing that 5.3% internal rate of return, even though it shows 6.3% on the illustration. So if that were true, we would have a 1% cost over the life of the policy. That's good. Let's see if we can calculate it to get exactly that same number they did, so we know okay, now I know how they're calculating it, and I know how to calculate it for my own future scenarios where I would like to do so. I'm gonna pull this up here, and you'll be able to see the numbers on the equation that we're gonna look at are all of the cash flows in and all of the cash flows out. In this case, our cash flow out is just gonna be the cash value at age 30, so we can try and line it up with the 5.3%. All of the cash flows in, as we see in the illustration, are the 92,080 and the 39,601. So let's line up each of those values with what year they're going in. So in year 0, right away, we are putting in the 92,080, and we continue that for 5 total years. So this is at the beginning of each year. It's the beginning of year 1, beginning of year 2, 3, and 4. At the beginning of year 5, we put in 39,601. So let's put year 5 there. And then at the end of year 30, we have our cash value, 2,103,188. Okay, so we have our numbers here. We have which year they're happening in. So I'm gonna put that number next to them. 0, 1, 2, 3, 4, 5, and 30. And then I'm just gonna create a simple formula to actually calculate these. If you wanna see the exact formula and not just copy the picture I have here, you can pause the screen right here now. And as complicated as the formula looks, it's really just the cash flows in, the cash flows out, and the year that those happened. And then the rate of return is the last variable. So all we did is align those again according to this formula right there. And then now what we're gonna do is we're gonna look at the IRR and we're gonna start guessing until we can get this number that's highlighted right here as close to 0 as possible. Once it's as close to 0 as possible, then we found our internal rate of return. So in this case, we are trying to get it to 5.3%. So when we put in 5.3%, that number should be very close to 0. So if we put in just a little bit above it, so let's do 0.06. So that's a 6% return. We can see we're pretty far away, right? Now, if we drop that to 0.05, hopefully we will be closer to 0. So we change it to 0.05. You can see it's closer to 0, but now it changed to positive. So we went past it. We got to go back up. Well, if we change it to 0.053, much closer to 0. Of course, we went past it here, so it means it's technically a little less. So what if we change it to 0.529? Okay, so we went past it the other way, so now we need to go back up. We need to add a little bit. So if we did 0.298, we can see 30, very close to 0, about as close as we can get. So we can assume here that the internal rate of return is 5.3% after 30 years. That is exactly how, in that example, Nationwide was calculating it. And now we know how we can line up our calculations with theirs. And if we were in a situation where an agent didn't give you that, this is how you can manually do it as well. Definitely one of my more engineering type technical videos, but if you enjoyed and you did find this helpful, be sure to like, subscribe, let me know, and I'm happy to make more videos similar to this in the future. I will see you in future videos.